What's going on, guys? MMuniz here. Welcome back to the channel. In today's video, we're going to discuss some big changes for 2023 when it comes to the IRS, retirement plans, individual retirement accounts, and even your marginal tax brackets. The cool thing about this video is it kind of applies to everyone. Whether you're an experienced investor or someone that hasn't even invested their first dollar yet, there's going to be some important information that you can get out of this video. And one thing I do need to mention is I'm not a financial advisor, and this video isn't financial advice. These are just my opinions. It's up to you guys to do your own research and determine what's best for you and your family. However, I will tell you how I'm handling the situation, and if you guys want to do something similar, that's completely up to you. So let's get into it. So first things first, let's talk about 401ks, 403bs, 457s, basically any employee-sponsored retirement account. What are they? What are the changes that are coming in 2023? Well, the most common, your 401k, is an employee-sponsored retirement account that allows an employee to contribute a portion of their paycheck into this account. And sometimes companies will even match a portion or a percentage of this amount and give their own money to that account as well, which is awesome. Now, 401ks are tax advantaged. If it's traditional, it's going to be pre-tax. If it's Roth, it's going to be post-tax. In terms of pre-tax, what that means is if you were to contribute $10,000 to a 401k and you make $100,000 a year, you're only going to pay taxes at the end of the year on the $90,000 because that $10,000 that went into your retirement account is contributed pre-tax. Now, when you take withdrawals, of course, you're going to have to pay taxes on not only the original amount you put in, but also the gains. So, keep that in mind. Now, with these employee-sponsored retirement accounts, there's a lot of restrictions as well because Uncle Sam wants to make his money. A couple things to keep in mind is you can't withdraw from these accounts until you're age 59 and a half. If you do before that, you're going to be facing some penalties of 10% plus the taxes. Now, there are loopholes around this. For instance, if you were to become permanently disabled or something along those lines, then you could start taking withdrawals prior to that without the penalty. But in an average case scenario, you're going to start withdrawing after 59 and a half or after you retire. Now, if you don't retire until you're 72 or later, you're actually going to have to start taking required minimum distributions once you're 72 years old. So if you're still working at 75, even though you might not need money from that traditional 401k, you're going to have to be taking money out of it. Even with a Roth 401k, which is contributed to post-tax, you still are going to face required minimum distributions. And the last thing to remember is if you pass away and haven't spent that money, it's going to go to your beneficiary, and they're going to pay taxes when they withdraw the money as well. So at the end of the day, if it's a pre-tax account, Uncle Sam is going to get their money. Now, there are contribution limits to limit the amount of tax advantage someone like you and me can get. And in 2022, if you are under the age of 50, you can contribute $20,500 per year. Now, the cool thing is, as much as we hate it, inflation has been so high, this has actually been adjusted significantly, almost 10% actually. It's now going to be a limit of $22,500 for 2023. Now, if you're over the age of 50, you can actually do an additional contribution, a catch-up contribution, in the amount of $7,500, which is an increase of $1,000 over the prior year as well. So if you are over the age of 50 and you're not in retirement and you want to contribute more, you can actually contribute up to $30,000 a year. Now, one thing I want to point out, because a lot of people ask this, and this involves the company match. If you make $100,000 a year and you put in 20% of your paycheck, so you put in $20,000, you are almost at that maximum contribution. Any money your company put in, for easy math, let's just say they put in $5,000 or 5%. They matched your first 5%. Your total contribution is $25,000, but that does not count towards your maximum annual contribution. Only the employee contributions count towards that. So even if you're maxing out your employee contributions, anything your employer gives you does not count towards that. So don't worry about that. Your goal should be to max out the employee annual contribution. If you can do that, based on your family finances. So once again, to reiterate, for 2023, if you are currently contributing the maximum of $20,500, you're going to want to raise that percent that you're contributing so that you hit the new maximum in 2023. So at the end of December, make sure you make those changes because a lot of times they take a paycheck or two before they kick in. So, my rule of thumb is max out your tax advantage accounts before you do other stuff with your money because that's how you're going to get the most money in the long run. Now, what about individual retirement accounts? Well, an IRA, whether it's traditional, which would be pre-tax, or Roth, post-tax, are going to be very similar, but they're not employer sponsored. So anybody can open up their IRA, and it's an account where you put money into, but you still have to invest the money. Make sure you remember that. But there are contribution limits as well. And the contribution limits for 2022 are $6,000, but 2023 has now raised that to $6,500. So once again, if you have an automated, monthly or weekly investment that goes into one of your IRAs, you're going to want to update that to hit the new maximum if you can afford to do it. Now, with the traditional and the Roth IRA, there's also the contribution catch-up limits when you're over the age of 50. And once again, that's going to be $1,000, but this has not changed. Apparently that one they don't adjust for inflation. The only other thing I want to point out about the Roth IRA is there are no required minimum distributions with the Roth. Also, you can actually pull out your money before 59 and a half because you've already paid taxes on it. You won't be able to take out all of it because then you'll start facing that penalty for the gains. But for the money you've put in, you can make those withdrawals. So all in all, with these new contribution limits, if you're under the age of 50 and you're doing $22,500 for your employer-sponsored retirement account, $6,500, you're at $29,000 a year that you're getting a tax benefit on, whether it's pre or post, it's up to you guys, or what your company offers. And that's something that everyone needs to be aware of. Now, another one that changed is actually the fan favorite, the health savings account, the HSA. Contribution limits for those have increased as well. Whether you are family plan or an individual, those contribution limits have gone up by 5%. Now, health savings accounts are triple tax advantaged and probably the single-handed best way to save for retirement. But I'm not going to take any time to explain that in this video because I do have a link in the description that goes more in depth on HSAs. But if you have an HSA, just know you can increase your contribution if that's what you wish to do. And also remember, if you have an HSA, the money in it can be invested as long as you meet a minimum threshold. So if it's just sitting there, think about putting it into an actual investment so you can make money. But what are my thoughts on these retirement plans? Well, depending on how much money you make, the answer is going to be different. So for someone that doesn't make a lot of money, you're barely scraping by, I would say that you have to at least be meeting your company match if they offer you one when it comes to an employer-sponsored retirement account. So if your company allows you to put in 5% and they're going to match that, you want to do that because that's free money. Set it, forget it at that 5% or whatever you can afford, and then it's going to come out before you even get your paycheck, so you're never even going to realize that that money's gone. So if you would have made $600 a week and now you're making $575 a week, you're not going to know that you had $600. You're going to see $575, you'll adapt, and you can move on, and you'll also know that you're saving for retirement. Now, if you make more money though, that's where it gets a little confusing because there's a lot of discrepancy in what financial advisors will tell you here and also what I believe. Some people will say, make sure you meet the company match for the 401k and then put your money into a Roth account first. So start taking advantage of that post-tax retirement account. But other people will say, no, max out the traditional first because, in retirement, you're probably going to be making less money. So, with the way the US tax system works, it's based off how much money you make or how much income you have per year. And when you pull money out of your retirement accounts in retirement, that's considered income. It quickly gets really confusing on what's going to be the best way. So what do? Well, I currently max out my 401k, $20,500 per year. And for 2023, I'm going to raise it by 2% to get to the $22,500. And yes, you can do the math if you want to figure out how much money I make from my 9 to 5. That's fine. I don't really care. I don't make a ton of money, but I do okay for where I live. And that's from my 9 to 5. So I also put money into a taxable brokerage account, but only because I can't put money into a Roth right now due to some tax implications for my wife and I. So we're forced to file married separately, but this may change soon, and I'm hoping it does. So in 2024, I should be able to start having a Roth again. And as soon as I do, I'm going to continue maxing my 401k and I'm going to max my Roth. And then everything else will go into the taxable brokerage account. So I'll be putting less money into the taxable account and more money into my tax advantage retirement accounts, which goes hand in hand with my belief that the first thing you should do is put the maximum into those tax advantage accounts if you can. But that's just me though. Who knows? Maybe that's wrong. Now, there are a couple more changes that the IRS made for 2023, and one of them being the standard deductible going up for both married and individuals. And also the tax brackets for your marginal rate have been increased as well. So for instance, if you're in the 24% tax bracket like me, then before, anything above $85,000 or so was taxed at that 24%. Now it's anything above $95,000 is taxed at that 24%. So you're gonna get a little bit of a break there. One thing to know about how our tax system works is if you make $100,000, once again for easy math, not all $100,000 is gonna be taxed at 24%. Only the amount from $95,000 to $100,000, those are average numbers there, is gonna be taxed at 24%. But then you're gonna have the previous taxes from the previous bracket and then the money from the bracket before that. So it's tiered. So it's not like, oh, you make $100,000, but it would have been better if you made $94,000 because you would have saved 2% on taxes. That's not how it works. The brackets are for anything above that maximum dollar amount. So if you're at 22% and your salary goes to $96,000, now anything above that bracket that meets that 24% is going to be taxed at that. Hopefully that made sense. If it doesn't, leave me a comment down below. But if you guys are still watching the video, let me know what you thought. Let me know what you think of the changes. Is it enough? Does it make up for the crazy inflation we're seeing and the cost of living going up for everyone? I want to hear from you guys. I do my best to respond to all comments. And also, if you haven't already, make sure you smash the like button down below, subscribe to the channel. We do weekly videos on anything related to personal finance or fitness. And with that said, I hope to see you guys in the next one. Take care.